Hello and welcome to this Cornerstone Finance Group podcast brought to you by Business News Wales and sponsored by Signature Property Finance. I'm Gemma Casey, editor of Business News Wales, and in this episode we're going to be looking at supporting property investors with non-regulated bridging. Well, from auction wins to major refurbishments, experienced investors often need funding fast, and that's where non-regulated bridging loans can come in. But what makes them different? When is it appropriate to use them? And how can mortgage advisors provide insight on this product? With me to discuss this are Haydn Thomas, CEO of Cornerstone Finance Group and Managing Director of Cornerstone Capital Finance, Loui O'Brien, Commercial Manager at Cornerstone Finance Group, and Tony Gilbertson, CEO of Signature Property Finance. Hi all, thanks for joining me.
Morning, Gemma.
So, Loui, can we start off by defining what we mean by non-regulated bridging?
Thanks, Gemma. I think in its simplest terms, a bridging loan is regulated if the property is or will be occupied by the applicant or their immediate family. And then conversely to that, obviously, if it's not and it's an investment property, then generally it's defined as non-regulated.
That's really clear. Thank you, Loui. And tell us then, when we're talking about non-regulated bridging, what would be some of the scenarios you might see when this would be appropriate?
Yeah, there's many opportunities where it can be useful for investors to use bridging. The common one which we hear a lot about is, of course, auction purchases where there's tight deadlines on completions. But on top of that, you've got refurbishments where clients could be looking to add value to the property. We've got below market value purchases, or even if they're just looking for a quick sale, they might want to take advantage of a discount and get on with their next project. That's when bridging could be used.
Tony, before we get into this discussion, tell us a little bit about Signature Property Finance.
We're an unregulated bridging and a development lender. We lend throughout England, Scotland, and Wales. I think it's quite probably appropriate for me to sort of go back a couple of steps in terms of how Signature started. So I'm one of the co-founders. Prior to starting Signature, I was bank trained by a high street bank. I was then a property developer myself for 10 years. So I was borrowing money myself from bridging lenders, development lenders. I was also a broker. So I was also put in deals to bridging lenders. So I don't just have we don't just have the sort of theoretical experience. We've actually got the practical experience of being, developers, being borrowers ourselves. And because of that background, in terms of my sort of investors, my debt providers, they allow Signature, myself, to be the ultimate decision maker. So again, that can be quite powerful when we're talking to people in that, one of the things that Signature is known for is certainty of funding, and Signature does what it says it's going to do. So, that's where, we one of our USPs is genuinely having those sort of decision makers that are within the company. And again, we're working with introducers, with brokers, it does make it a lot more sort of straightforward. And also, we are very practical people, I said, because we've been there ourselves. And I know sometimes I probably get criticized for empathizing too much with developers. But, again, quickly, I tell the story. I brought 23 new built flats to the market in 2008 as the financial crisis started. Um, that's when I fell out of love being a developer and thought I'd become the borrower, the lender rather than the borrower. But having been there, and one of my mantras is I will never treat one of my borrowers the way that my lender treated me in 2008. Of those 23 flats, I still own 2 of them today. But at the time, as a lot of developers will know, it was just trying to keep your shirt and coming out the other end. And that has put me in a good stead then when I started Signature to be seen as more of a practical lender, and that's what we try to be.
Yeah, you've really walked the walk then, Tony.
Yes, yeah.
Now, Louis given us a great, clear definition of what we mean by non-regulated bridging. Tony, talk us through what are the benefits for clients in accessing this product?
In terms of non-regulated, it's anything you're doing for business purposes, essentially where you want to make a profit. And that's the bottom line. one thing with bridging, you will pay a premium on the pricing than a, say, traditional buy-to-let. But say that premium in pricing is because of the service and the speed of response. Because again, let's use an auction purchase as an example. Typically, the hammer goes down at the auction. You've exchanged contracts. You then have 21, 28 days to complete, unless you've prearranged your buy-to-let mortgage before the auction. With the best will in the world, it's unlikely that a buy-to-let lender will be able to perform and be able to release that money within that 21, 28-day period. Bridging lenders, we're all geared up to work to those timescales. Well, with Signature, I even employ in-house lawyers. So I've got my own lawyers in-house because that process. One of the things that does slow it down is the legal process. So having those guys sitting 10 yards away from me, we work together to ensure the deals can complete within the timescale required. Similarly, we work with a panel of valuers, surveyors that we need them out quickly to get reports back to us. We also have some products up to sort of property values of 500,000, where we have the ability to use desktop valuations. So again, there's no physical inspection of the property. It speeds up the process, to allow us to hit that. So, and that's the important thing, I think, for developers, landlords to sort of appreciate it. Yes, it'll be slightly more expensive to use a bridging loan than a traditional buy-to-let, but it's the opportunity cost. It may cost you, £5,000 more with a bridging lender, but you're going to make an extra 50 grand profit on that property because you had the ability to buy it within 30 days. So that's one of the things that people need to realize is, comparing the direct cost of a bridging loan to a buy-to-let loan, it's apples and pears. Yeah, ultimately, if you can go straight into a bridging loan, into a buy-to-let loan, yeah, great, because I say that's the cheaper form of funding. But that's sort of the exception rather than the norm. And we are there to allow people to access those opportunities, because you may have somebody it's a distressed sale. They need to sell it within the next 14 days, and if they can sell it in the next 14 days, well, they'll reduce the price by 20%. Well, okay, if it costs a little bit more with a bridger to release that 20% extra profit, that's where the bridging sector as a whole fits in.
If I could just add on to that as well, I think Tony's absolutely right. And also one alternative I hear from clients as opposed to bridging is buying properties in cash. But what that can do in a lot of instances is tie up an investor's cash. If they're using bridging and using it correctly and pricing it into the model, and having a full understanding of what it's going to cost, they can have multiple projects on the go at the same time, as opposed to tying up their cash in one product.
And Loui, tell me a little bit about how a typical unregulated bridging loan would be structured. So we've talked about the benefits there, but how does it work in reality?
Firstly, the way I always describe a bridging loan to a client is effectively like a short-term mortgage. They still take in first charge over the security property. The term length tends to be anything from sort of 6 months up to 36 months for some lenders. And the key is that it is a short-term facility. It's not a long-term facility. But there's multiple benefits in the way it is structured. So a big one is the way the interest is paid. So there's different types of interest. So we've got retained interest, where the total term interest is deducted from the gross loan day one, and then it's repaid on redemption. What that means is, whilst the property's not let out and achieving rental income, the applicant doesn't need to pay or service monthly repayments. So, that's not affecting their cash flow month on month. Conversely, then, if they want to maximize loan to value, they can opt for a serviced option, which works just like a mortgage. But yeah, having that ability to not have to service the debt monthly is probably the most common way we see investors using it effectively, and keeping their capital to spend on refurbishments and other projects.
I think I'd like to sort of add into that, from a lender's perspective, if it is sort of retained, rolled up interest, we don't critically then look at affordability because it's within the facility. Whereas if you wanted to service it, as a responsible lender, we need to ensure that the client can afford to service it. So, I think that's another sort of that's where sort of people sort of push maybe towards more the retained, the rolled up, because they don't have to worry about servicing it. They don't have worries of refurbishing it to get it onto the term facility.
And Louis, how important is it that a mortgage advisor is really clearly talking to their client about their exit plan with this product?
Yeah, absolutely. I think it's probably, if you speak to any bridging lender, and I'm sure Tony will vouch for this, that the thing bridging lenders care most about is how we're going to get repaid. As Tony will tell you, it's quite easy to lend the money, but getting it back is the challenge. So I think, us being professionals in the industry and acting responsibly need to make sure that this does work for the client and they can exit the bridging finance, because ultimately that the property could be repossessed if they can't. So most common ones in terms of bridging would be sale. So someone might be buying a property, adding some value, and then selling it to make a profit, or it could be to add value and refinance against the uplifted value. So I think from a mortgage advisor or a commercial finance advisor looking at it, it's making sure, okay, will this property achieve the rent the client thinks it's going to achieve the back end that will allow us to refinance, or will it achieve the sale price that they expect?
Definitely, I'd sort of reinforce that in that at Signature, we never want to put somebody into a bridging loan that we know we can't get them out of. Because all you're doing is deferring a very awkward conversation until the expiry of the loan. And I say one of the things that linked to that then is the term of the loan, because if the term is too short, well, realistically, they're not going to be in a position to have finished the property, had time to refinance it. So we need to ensure that the term of the facility is realistic to achieve that exit. And again, when it is a sort of refinance, we sort of then will speak to the introducers, the likes of Loui, to say, look, we know you're not going to give me a credit back offer letter to get this out onto a term facility, but we trust Cornerstone. If they say, we've got an agreement in principle, we are confident we can get the client out, that's enough for me. And that's part of the importance of the relationship between the lender and the broker, because it's sort of a trust thing both ways, because again, you're never going to have that cast iron exit when you draw down the initial loan.
Haydn, let's bring you in here. So we are familiar with hearing from you on these podcast episodes in your role as CEO of Cornerstone Finance Group, but today you're also here wearing a hat as Managing Director of Cornerstone Capital Finance. Tell us a little bit about Cornerstone Capital Finance.
Thanks, Jem. Cornerstone Capital Finance is our own in-house bridging fund. It's not on the scale of Signature, but to be honest, what Tony's done at Signature and achieved at Signature over the last 10 years is a bit of an inspiration for us, because it's a business that's built on strong relationships, doing what you say you will do, and really focused on client and introducer stroke broker. And I guess what we have is a smaller version of that. So it's privately funded. We're quite niche. We tend to focus on high net worth, where we're maybe asset rich, cash poor, looking to move quickly on opportunities. We also are pretty specialist in the agricultural sector, so we're one of the few bridging funders out there that will look favorably on agricultural land and farms. And then we work really, really closely with our top bridging funders, of which Signature is certainly one, to kind of fill the gap sometimes where maybe it's not quite right for the more mainstream lender, but we really like the client, and the client's got a really good track record, and we're prepared to do something a little bit quirky and a little bit different. So 50% of our business is repeat clients already. We launched 2021. We lent about 15, 16 million to date. Current book is just over 6. And touch wood, we've got all our money back so far. So and that's the key. We've had a couple of hairy moments, but we're okay at the moment. But I think where we slot into the market is very much, we work really closely with Loui and the guys in the Cornerstone commercial team, and then we work pretty closely with a few of the other funders where maybe they don't have an appetite where we do. and we kind of fill that gap. But it's very focused on client. We're opening that up to the Cornerstone network advisors now, and we're seeing some quality introductions from some of those guys as well, where they've got property investor where they've been doing the buy to let business for many years, and they're realizing the importance of bridging in that space to take advantage of opportunities, and build and starting to understand what Tony talked about in terms of that opportunity cost, because that is the key. Yes, it looks more expensive, but when you look at true cost over time and opportunity cost of not doing it, that's when bridging comes in.
And you mentioned there opening the opportunity up to advisors. Haydn, how familiar would you say advisors are with this product? Is there a gap in the market? Is there an opportunity for advisors to be doing more of this type of finance for their clients?
There's definitely an opportunity. However, I'd probably caveat that with experience, knowledge. In your standard mortgage and protection advisor, a broker out there in the network, non-regulated bridging is probably a bit of a dark art to them. I think we're making inroads in terms of regulated bridging in the network. But my first advice on non-regulated bridging will be referring into the commercial finance team, the guys like Loui, who've got the expertise and have got access to the whole of market. We will be one of those options in Cornerstone Capital, but we're a very small part of that. There are, Tony will tell you, I don't know the numbers, but there's over 100 bridging firms out there in the UK. We probably, whilst we're registered in our commercial finance team with pretty much all of them, there was a couple we've kicked off panel because we don't like them. But we're registered with pretty much all of them, but we concentrate our business on, again, Loui will probably tell you, between 10 and 15 of them, and they're people that we trust. They've got the offering covers the whole of the market. Cornerstone Capital is one of those 15, because we fill a few gaps. But there's a lot bigger players out there that do a lot. We don't do light refurb, in the essence that Tony would do it, or heavy refurbishment. We don't do development. We don't do service. So in that commercial team, they've got the knowledge, the experience, and then the access to all of the best funders, I would say, in the UK. So in the first instance, the advice to the people in our network is referring to the commercial finance team, and they'll find you the best deal. I think over time we will work, and we're already talking to Tony and a few others around how we take the training program that we brought in on regulated bridging, and for those brokers that deal with a lot of property investors who do a lot of buy-to-let, we run a similar training program to say, okay, you should be able to introduce straight into a set panel of approved non-regulated bridges, because we think you've got the skills and the ability to explain the product and explain the opportunity to clients. But until you have that, referring to the guys in the team, in commercial, and they will get you the best deal in the market.
Thank you, Haydn. I'm conscious of time, so we are coming towards the end. So, Loui, what would your message be to anybody listening to this who is thinking maybe there are opportunities here for me and my clients?
I would say, firstly, don't be afraid to have the conversation. You don't need to be an expert in it to get a referral in. It's just asking the basics, and the team in here in Cornerstone Commercial is always open to having these conversations with advisors in the network of quick trigger questions, and identifying opportunities really for their clients, and just coordinating that smooth transfer over to the commercial team. We're all under the same banner effectively, and we'll look after your clients the way you would want them looked after. So yeah, don't worry about being an expert. Not everyone's an expert in everything. And just get the initial details and get them into the team.
And Tony, final word to you. Now, you mentioned earlier on the importance of relationships between a lender and a broker. And I know that relationship is something that Cornerstone 100% buys into as well. So Tony, how important do you think it is that an advisor builds that relationship with their property clients so that they can recognize these opportunities when they come in front of them and they can really support their property clients with this type of product?
Oh, 100%. And one thing with Signature, we are sort of relationship driven. People buy off people. And for an introducer, and as I'll go back to something that Loui mentioned in terms of it. When I was a broker, I thought bridging was a dark arts. And it can't be complicated because I do it. And I think that's where the sort of the mortgage advisors need to realize, it isn't complicated, but it's having, a bit of knowledge to identify something and ask one or two questions. And I always say there's no stupid question either. It can be sort of very lucrative, for all concerned, because if the mortgage advisor can identify, the product for their customers, that they can buy this property quickly and they can make more money by being able to buy it quickly. That's great then for the developer. Then for the mortgage advisor, well, obviously there's an income stream from doing the bridging loan, which happens very quickly, and then over time then is another income stream when they do the term facility. So it's it's a win for the developer, it's a win for the introducer, and it's a win for the lender. So everybody's winning out of it. And then if everybody's winning, then everybody's motivated.
Yeah, brilliant. Well, that has been a great whistle-stop tour and a great introduction to non-regulated bridging. Thank you very much to my guests, to Haydn, to Loui, and to Tony. And thank you for listening to this Cornerstone Finance Group podcast.